Welcome back. Well, it was a historic day, right? It finally happened. The Federal Reserve raising rates for the first time in nearly a decade. Now, those rates, well, they only went up a quarter point to a quarter percent, right? But it was unanimous. Everyone agreed. Joining me now, Fox Business's very own Liz Claman, James Rickards, the Death of Money author, Shah, Gilani, Capital Wave Forecast editor, and David Nelson, Belpointe Asset Management chief strategist. Liz, I got to go to you first because we've been waiting for this for a long time. There were a lot of everyone had a different opinion on what was going to happen to the market. But what really happened, and do you think Janet has Wall Street sort of under control, at least for now?
Okay, what really happened? Nothing. Nothing.
Right, good night, folks.
Okay,
we'll see you tomorrow.
A tiny quarter of a point. It was nothing, yet it was something. It was major because we have finally seen liftoff of the rate tightening cycle, although that cycle is going to be extremely choppy. I don't know, the tone that Janet Yellen had was extremely confident, very calm, very measured. It made you believe that's what we'll see with future rate hikes. Calm, measured, but not specifically every certain amount of time. So what you're expecting now is that they will look at every piece of data. They won't be dramatically moving in any way, shape, or form. She made that very clear.
You know, Jim, here's the thing, though. Maybe she was too confident. It was pretty interesting. Everyone should know that the Fed also put out their economic forecast for the next 3 years. Nothing changed. GDP didn't change from September. Unemployment was tweaked just a little bit, and inflation didn't change. In fact, they see inflation not even at 2% until 2018. Maybe she set herself up by being too confident about what the Fed can do and where the economy is going to go.
Sure, Charles. We'll look back at this. This will be one of the great blunders in Fed history. Actually, if you look at the tape, when Janet Yellen used the word confident, her eyes shifted, which is sort of a tell. She doesn't really believe it.
So if you were playing poker, you would have gone all in.
Absolutely. They're racing into weakness. It's as simple as that. We're heading into a recession. You don't raise rates into a recession. The time to raise rates, of course, was 2010, 2011. Two wrongs don't make right. Their failure to raise rates then is not a reason to raise rates now. It's just a double mistake.
Although, Shah, let's face it, all of those eye watchers and those poker players on Wall Street, there were some smart people who did not think the Fed would hike rates today, and they were looking for the market to go down. I'm not sure what camp you were in, but there was a lot of smart people in that camp.
I've been expecting this rate hike. It's overdue, and the reason for it isn't that there's any inflation. The reason for this rate hike is to cool off the inflationary bubble that financial assets are experiencing. That's what this rate hike is really about. And the sense of them putting forward this idea that it's going to be gradual is to not spook markets. This has nothing to do with the economy overheating. This has nothing to do with anything but the asset inflation bubble.
The asset inflation bubble, you don't have an S on that. What asset? You're only talking equities. What else could be?
Bonds.
What else is bubble issues?
Bonds, leveraged bonds. The leveraged bond market is way overheated. The junk market is out of control. It's facing some kind of near collapse. Equities are overdone. There is no inflation. We're experiencing deflation in terms of commodities, in terms of oil, in terms of everything you look at. We're heading into a deflationary spiral, not an inflationary spiral, which is why the Fed would normally raise rates.
And yet the market was up over 200 points, David. And here's the thing people should know. You go back to 1957, I think there have been at least a dozen of these rate hike cycles when they start all over again. Always we get a market rally. In the last four, the first year we were up every single time. In fact, the 2 years out, it wasn't uncommon for the market to be up substantially. The only time it didn't work was with the crash. But then we had valuations that were double where we are right now.
You know, I'm going to take the other side of some of this argument here, and who doesn't know what tomorrow will bring, but we're talking about should the Fed have done this. The fact is that the Fed missed the window back in 2013. They're way too late on this. It's had unintended consequences. Corporate America has been on a debt-buying binge. They're using that to buy back stock, and that comes at the expense of research and development, capital expenditures. In the end, they're not reinvesting in America. They're not reinvesting in their company. So I think they had to do something now. They realized that they were pushing on a string, and what they were doing was just having unintended consequences.
So help me out. I'm trying to figure it out. For you, the Fed was trying to reel in corporate America, I'm trying to figure it out because it feels like everyone's got a different take on this.
Look at the market right now. You know, you have a bifurcated market. You know, you have winners and losers, and we've been on.
Yeah, more losers than winners. We always point that out.
Yeah, more losers than winners, but we're riding higher on financial engineering. I think the Fed actually understands that. I've been speaking about it for, the last couple of years. Every company out there is buying back stock, and eventually you turn into IBM. They've been buying back stock, $13 billion every single year. What is it getting them? Eventually, even a Boeing, which just announced that they're going to buy back stock, even more stock. What does that mean to the research and development budget going out in the future when they have to develop new planes?
Although Boeing stock not too far from the all-time high, $14 billion buyback. I mean, ultimately, the essence of investing is that you get a return from the company. Either it's through dividends or through share appreciation. If management can make the shares go up by taking more shares out, you can argue it's financial engineering, but it's probably doing what their job is if they're beholden to shareholders.
I have never heard, not just on this set, but on so many different discussions about this, so many Monday morning, I guess it'll be Thursday morning quarterbacking, but come on, this is not a big deal, guys, when it comes to how much they decided to raise. And what have we had? We've had exactly what has been articulated here, and that is people buying back their own stock, engineering it. IBM, I don't know why Warren Buffett's in that stock anyway. It hasn't done well. He's still a believer. It's a good business, but it hasn't done anything. What harm will the Fed do by raising a tiny bit when, what do we have? We have a slightly improving labor market. We had housing starts up 10.5% today,
Right.
Charles. It's not the worst month.
That housing start report, I think, was a gift for Janet Yellen. That fell right in her lap.
But you look at production right after that.
Right, I know. Well, then that's what listen, we have two economies. There's no doubt about it. The industrial side, a lot of that, though, can be traced to maybe the global situation with deflation, China, a lack of demand for this kind of stuff, copper prices at all these lows. But, Jim, here's the other thing, though. $4.5 trillion on the Fed balance sheet. At some point, don't we have to become worried about them getting rid of it? I mean, I compared it to that Yucca Mountain where they keep all the nuclear waste. I'm wondering which one goes off first.
Well, we do, because the next financial panic on a par with 2008, which we should expect in the next couple of years, because they do happen every 7 years or so, 1998, 2008, maybe 2018. Where's the dry powder to deal with that crisis? I mean, Liz says it's only 25 basis points. That's right, but it's not about the 25 basis points. It's about the expectations. It's about bringing that whole futures curve forward.
Can you imagine if they hadn't tightened rates today?
Well,
people would have flipped out of their minds.
No, you're right.
Much worse than they are.
Well, you're right, Liz. And by the way, you know, Shah and David both talked in different ways about puncturing asset bubbles. Now, that's not what Janet Yellen said, but they may be right. And if they are, look out below, because how do you pop a bubble slowly? It pops all at once.
Well, then here's the thing, though, Shah. I think the key now for Janet Yellen is to articulate to Wall Street over and over again that, hey, I'm going to raise rates next year slowly, not every time we get together, because she's in a box. If she doesn't raise rates, it's an admission that the Fed, at this point, it could be an admission that the Fed shouldn't even exist. I mean, if you've gone through all this extraordinary stuff and you could not spark Main Street after all of these tricks that you've done, all of the gimmicks that you've done, all of the toxic debt you bought, maybe you shouldn't even exist. Now, having said that, how's she going to pull that off?
There is no reason for the Fed to raise rates. There is nothing else that they have to do. This was a signal to the markets that we're not going to allow this to continue. We're going to pierce this slowly. They cannot afford to raise rates anymore. The market doesn't justify, the economy doesn't justify raising rates. There is no inflation, so there's nothing for them to do. They've done what they have to do. They sent the signal to the markets. We've taken a foot off the accelerator. We're going to decelerate a little bit. We're going to kind of deflate the asset bubble. That's all they've said here. And there's nothing
for now, it was a Goldilocks day for the Fed and for Wall Street.
Because historically,
the jury's still out for the rest of the country.
Historically, markets look at the Fed raise hike cycle as something to get it's the tailwind of the economy moving forward. They want to grab the last bits of it. This is not the case now.
We got to leave it there.